Today's episode is brought to you by Mazars.
SoundCartel.
From SoundCartel, I'm Nicole Goodman, and this is Business Essentials Daily. At 3.6%, the current RBA cash rate is the highest it's been for about a decade. Raising the cash rate is the Reserve Bank's way to tame inflation, and so there might still be more coming our way. As cost of living becomes increasingly expensive, it's worth looking at your current financial position and developing a plan for both near and longer term. That's according to Owen Dingle, partner at Mazars Financial Advisory Team. Chris Ashmore asks Owen how he sees businesses adapting to the pressures of inflation and higher costs.
What we're seeing is businesses making key decisions around do they need to increase their prices to offset inflation. A number are looking at cost-cutting or efficiencies where they may be able to reduce some expenses. And longer term, some of our clients are really looking at their expansionary plans and do they really need to be doing those projects now. I think it's really key in having a good budget and understanding your cash flow management, but also really having that conversation with your bank about where your business is going.
The RBA's cash rate increases have led to bank interest rate rises. What impact are you seeing this having on business?
Look, one of the biggest things that we're seeing is deals are getting a lot harder to get through banks, particularly maybe if you're looking to refinance or expand your business and acquire another one. So when you're looking at the debt servicing side of things, ultimately banks will look at what is the cash rate now and your interest servicing costs. But ultimately they do want to see that businesses have the ability to repay debt. And so when we start to look at that over a longer term, interest rates coming off arguably somewhere around mid-2s to 3s. We're now starting to talk a bank rate of around 6%. There's been a lot of talk in the media around sensitised rates. And ultimately, when you apply that sensitised rates over a notional term, deals that were probably just flying through the approval process before are now finding it that bit more stringent. So ultimately, what we're seeing with businesses when looking to apply for additional finance, whether that be working capital or expansionary money, we're finding that all of a sudden those deals that were easily meeting bench hurdles are now that bit tighter. We're not seeing it to the extent that it's of a major concern, but nonetheless, it's really something that you need to be aware of when applying for bank finance.
What about cash flow? How is it all impacting cash flow?
Look, ultimately, as I said, it is quite tough out there for business at the moment when you're looking at what the future may hold, particularly when you look at the global environment at present. There's a bit of instability in the banking system globally, which is leading to some concerns here in Australia. I think ultimately we have a strong banking system in Australia and there is quite a bit of cash still available. Bankers are wanting to still lend, but ultimately the person that needs to pay back the bank is ultimately the business. And it needs to be the business owner that actually is comfortable with borrowing the money. And it's their business cash flow that they need to be monitoring and certainly having confidence that they've got that ability to service any additional funds, but certainly even their own current debt levels. So I think there's a lot of introspective thinking at the moment with regards to debt levels in business. And certainly a lot of people are pausing before they take that next step. And what we're seeing the RBA doing with raising rates is that's exactly what they want, one would presume.
Well, it's a double whammy, isn't it? Rising costs and higher interest rates. How can businesses budget for the changing business environment?
Well, look, I think that's a really good question. Ultimately, businesses need to be looking at probably their 3 to 5 year business plan. And what we're seeing is clients really looking at their project pipeline and saying, look, we've committed to the next 12 months, but what does the next 2 to 3 years look like? So they're saying to us, ultimately, we've committed to these projects now, but let's just sit back and see what happens in the next 12 months before committing to a stronger pipeline. The second thing is I think it's really important that you understand where your business is at the moment. And in Mazars, we're an integrated firm as professional services. So I look after the financial advisory, but talking with the accountants, it's really about having an understanding of where your business is at and ensuring that your accounts are up to date, not only from a financial reporting point of view, but also your management figures. And there's also been, the ATO has been one of the largest banks in Australia, particularly after the pandemic. And I think bankers are very much aware of that. So they're going to be looking at your business and wanting to know that you're up to date with your ATO commitments, that you've got clear portals. And it's not only that, but one of the things about rising interest rates is that it was much easier for a deal to be standing on its own two legs from a debt servicing point of view, particularly 24 months ago, even 12 months ago. Now that banks, by nature, are having to look more closely at debt servicing, they're looking more closely at everything else in the business. It's not to say they weren't looking at these things, but some of the things that they are looking at is particularly around, do you have a tidy credited ledger? Are debtors being managed? And they're really focusing in on those key drivers of your cash flow in your business. And we're finding that clients that are on top of all of these points are really able to access capital quickly, but also, more importantly, being able to get a better rate and being more attractive as a potential refinance to a bank.
So businesses are looking to refinance for a better rate?
Oh, yes, this is definitely a refinance market. The bankers know it. A lot of clients know it. Because it comes back to that point, Chris, that you mentioned. How do you handle your expenses in an inflationary environment? When interest rates were arguably between 2 and 3% for most businesses, when you start to nearly double, if not treble that rate, all of a sudden it's going to be really prominent in your P&L. So when businesses are looking to slimline and cut costs, then interest rates are definitely going to form part of that review process. And certainly I think the great thing about the Australian banking industry, touch wood, is that it's well regulated, well capitalised, and there is a lot of money in the banking system. So what that means is that there's healthy competition, particularly for small business. And for those businesses that can demonstrate those characteristics that I spoke about earlier, there is a great opportunity to be able to go to market and get a competitive rate.
And what does a successful refinance look like?
Look, I think ultimately, Chris, it's about not only a good rate, but also finding a bank that understands your business and the industry. So we've all seen in the past where banks may offer a honeymoon rate, and then lo and behold, the industry changes or they get a full loan book and then all of a sudden they reprice. So we always work with our clients to ensure that the banker is the right fit, and the bank, ultimately we also see that bankers will come and go in the industry. But from our point of view, it's very much about the combination of a good banker and a bank that meets your needs. And the thing about banks is that from time to time, they have different risk appetites and they also have different specialities. So, for example, a bank that may be good in business banking for a commercial property investor may not be the best bank for an agribusiness borrower, because they're two very different markets and needs. And one of the things that we pride ourselves on in Mazars is that we have a wide range of banks that we work on, predominantly on a fee-for-service basis. And we like to think that we're independent and can work for our clients independently and help to not only get the best deal, but also the right banker. And to add to that, I think it's really important that you have the right structure in place. It's got to be fit for purpose. I mean, if you've got really large growth plans, recently I had a client that we met with a potential refinance to another bank, and the bank asked what was her growth plans, and they were quite ambitious. You know, she doesn't apologise for that. And the bank said, well, look, that's probably at the upper end of our risk profile. So that was good to know in that first interview, as opposed to going through a full application process and refinancing to that bank to only find out that their risk appetite isn't at that level to go to the next stage, when clearly that's what my client would like to do. So I think it's really about having those conversations and being clear for both parties. Where does the business want to be in 5 years? What's the immediate needs now? And are the facilities structured in the right way to meet cash flow needs, but also put the business in a position where it's able to meet its 5-year business plan, but also have the resilience to be able to handle possibly some changes in the economy, which we're certainly seeing at the moment.
That was Owen Dingle, partner at Mazars Financial Advisory Division. This episode of Business Essentials Daily is produced by the team at SoundCartel. Thanks for listening. I'm Nicole Goodman. We'll bring you more Be Daily tomorrow. Follow @BE Daily Podcast across social media and head to bedaily.com.au for more from the Business Essentials Daily podcast. SoundCartel. This episode was brought to you by Mazars. To find out more, visit mazars.com.au. That's mazars.com.au.